Venice was not born to be a financial empire. It had no broad farmland, no great forests, no rich mines. It sat on mud and salt water, a scatter of islands in a lagoon, exposed to storms and surrounded by stronger powers on land. Yet for centuries, this city behaved like a machine that turned distance into profit, and profit into credibility. Venice did not simply trade. Venice learned to make trust portable. That is what banking really is. Begin at the Rialto, the city's commercial heart. Picture bridges, warehouses, counting tables, ship agents, and small offices where candles burn long after sunset. Crates arrive smelling of pepper, wool, wax, and seawater. Prices change by the hour. Promises move faster than coins. In a place like this, money cannot be only metal in a purse. It must be a system that keeps commerce moving even when ships are months away. Long-distance trade has a brutal problem. Time. A voyage can take an entire season. A storm can erase profit in a single night. A blockade can trap cargo. Pirates can make a ledger entry meaningless. So a merchant needs more than courage. He needs credit, partners, contracts, insurance, and a way to pay and be paid without hauling chests of silver across open water. The first Venetian bank was not a building. It was a habit, the habit of recording obligations, sharing risk, and settling accounts on schedule. That habit grew because Venice was forced to live by exchange. The lagoon could not feed the city. The city had to buy survival, and when survival depends on buying, payment becomes sacred. Venice's political design helped. It was a republic with a strong state and a ruling elite deeply tied to commerce. Predictable rules make contracts safer. Safer contracts make credit cheaper. Cheaper credit expands trade. Venice understood a quiet truth. Law is not only justice. Law is infrastructure. Now look at the coin that carried Venice's name across borders, the gold ducat. In the late Middle Ages, merchants wanted a gold coin they could trust in distant markets. Venice introduced the ducat in 1284 and kept its standard remarkably consistent. That consistency mattered more than ornament. A good coin is a message. This city keeps its word. When strangers accept your coin without argument, your influence travels ahead of your ships. But coin has limits. Coins can be clipped, stolen, sunk, or stopped by war. And a city that lives on the sea cannot allow its entire economy to depend on metal moving safely from hand to hand. Venice needed promises that behaved like money. This is where Venice begins to look modern. Venetian merchants used credit instruments that let value move faster than ships. The simplest example is the bill of exchange. Instead of carrying cash, you carry a claim. You present it in another city and receive payment there. The claim works only if a network stands behind it. Correspondents who keep books, enforce deadlines, and punish dishonesty. Venice built those networks wherever it traded. In ports and fairs, in foreign quarters, and inside merchant houses that functioned like small financial firms. A Venetian merchant could sell cloth in one place, buy spices in another, and settle obligations through partners who never saw the same cargo. Each successful settlement strengthened the network. Each default weakened it. Over time, the city learned to reward reliability and isolate fraud. Money empires form like this, not by loud conquest, but by quiet consistency. Trade also required scale. This was not only private adventure. The state regulated routes, managed convoys, and invested in naval capacity. The Venetian arsenal, the state shipyard, built and maintained ships that protected commerce and projected power. A financial system needs muscle, because trust at sea often depends on protection. Credit is easier to extend when the borrower's ships are likely to come home. Yet even with networks and respected coin, Venice faced a recurring danger. Private banks fail. In any commercial hub, some bankers are careful and some are reckless. Depositors panic. A single collapse can freeze payments across the marketplace, and when payment systems freeze, trade dies. So Venice did something that looks obvious today but was bold then. It created public banking. In 1587, the Venetian Senate established the Banco della Piazza di Rialto, intended to make deposits safer and settlements more reliable. Merchants could transfer balances through the bank to settle large payments. Instead of pushing heavy coin across the city, they pushed entries across a ledger. The point was not convenience, the point was continuity. Imagine a merchant at a counting table. A ship has not yet returned, but invoices must be paid. He can either search for coin and risk theft, or he can order a transfer at the bank, a clean movement from his account to another merchant's account. The bank becomes the city's shared memory. It holds who owes what, and it moves value with a pen stroke. This is the moment Venice becomes something more than a marketplace. It becomes a payment system. If merchants trust that a deposit at the public bank can be transferred to settle a bill, the deposit behaves like money. Not because it shines, but because the city stands behind the rules that make it transferable and believable. The Banco di Rialto also imposed discipline. It was expected to keep deposits convertible into coin, limiting the temptation to create promises that could not be honored. Venice also pushed commerce towards the bank by routing key settlements through it. Centralizing settlement makes a market legible. It reduces disputes. It lowers the chance that one private failure will infect everyone. But Venice kept evolving. In 1619, it created another public institution, the Banco del Giro. Giro means transfer by book entry, and that is the heart of the idea. The Giro Bank expanded the practice of settling through account movements, further reducing the need for coin in major transactions. Over time, it competed with, and eventually overtook, the Rialto Bank as the dominant public settlement mechanism. Here is the crucial leap. Once deposits are widely accepted for settlement, the city has created bank money. Merchants can pay by transfer instead of by metal. That reduces physical risk, speeds commerce, and standardizes value inside the city's market. It also gives authorities a clearer view of flows, who pays, who receives, and where stress is building. Venice's public banking experiments became a reference point for later European finance. Other cities watched the logic closely. Supervised settlement, standardized book transfers, and public credibility supporting private trade. In time, public banks elsewhere adopted similar features, building on the Venetian lesson that a marketplace runs better when settlement is treated as public infrastructure, not only private improvisation. To understand the power of this shift, keep it simple. Coins are individual objects. They must be weighed, guarded, and moved. Ledger money is collective agreement. It turns payment into information. If the city trusts the ledger, then a merchant can settle a debt without touching metal, and 100 deals can close before sunset. That speed changes everything. It lowers transaction costs, reduces theft, and makes credit safer because repayments can be scheduled and verified. In a crisis, this matters even more. Picture a rumor spreading that a private banker is insolvent. Without a trusted clearing place, every merchant hoards coin, refuses drafts, and trade stalls. With a public settlement bank, merchants can keep transferring balances and keep pricing goods, even while fear rises. The city buys time, and in finance, time is often the difference between panic and survival. That is why Venice's banking story is really a story about keeping commerce alive when trust is under attack today. This is the pattern to notice. First, Venice standardizes a coin to win trust abroad. Then it builds credit instruments to move value faster than ships. Then it builds public banks to stabilize settlement at home. Each step follows the same principle: reduce friction, reduce uncertainty, and make promises tradable. That is why Venice resembles a bank. A bank does not mainly store money. A bank organizes trust. It matches savers and borrowers, buyers and sellers, present value and future value. Venice did that at the scale of a maritime republic. There is another ingredient, less romantic but essential. The state itself was a borrower. Fleets, diplomacy, fortifications, and wars were expensive. Venice financed itself through taxes, but also through borrowing, often from its own citizens and institutions. A government that borrows must maintain credibility or pay more. Public banks helped by keeping claims transferable and payments orderly, thinning the line between public finance and public banking. If you step back, you can see the early outline of what later centuries would call central banking. The questions are familiar. How do you keep payments flowing when confidence is fragile? How do you provide liquidity when merchants need to settle quickly? How do you prevent one bank's failure from freezing the whole market? Venice did not answer these with modern tools, but it did answer them with structure. Supervised settlement, standardized value, and public institutions that merchants could not easily recreate elsewhere. Venice's success also had a culture behind it. The Venetian merchant was a professional, he lived in contracts, he measured risk, he expected paperwork, he respected deadlines. A society that prizes accounting can run a large financial system because bookkeeping is memory, and memory is the skeleton of credit. The romance of Venice is canals and marble. The working reality is ledgers, seals, witnesses, and signatures. And the system created a quiet feedback loop. The more Venice could settle payments smoothly, the more merchants preferred to trade through Venice. The more trade flowed through Venice, the more useful its instruments became. The more useful the instruments became, the more the city's reputation hardened into an asset that could be borrowed against. Venice was compounding trust. But no money empire lasts forever. Banking is a promise business, and promises are sensitive to shocks. Plague can empty streets. War can disrupt routes. New ocean paths can move commerce away from old hubs. Competition rises. Costs rise. Public banks can face political pressure, especially when governments want easy funding during emergencies. Over time, Venice faced a world where the center of gravity in trade shifted towards the Atlantic, and a lagoon republic could not dictate terms the way it once did. Still, the Venetian lesson is not decline, it is design. Venice shows that money is not only a thing, it is an agreement supported by systems. A trusted coin is a system. A bill of exchange is a system. A public bank is a system. And a state that enforces rules is part of that system. When those systems work together, a city can turn reputation into purchasing power. So when we say Venice became a bank, we do not mean it built a single building and called it done. We mean the city engineered an environment where trade could rely on settlement, where credit could circulate, and where reputation could be converted into money quickly, even across distance and danger. If you want a final image, return to the Rialto at dusk. Merchants fold papers, seal contracts, close ledgers, and step into the narrow streets. The day's cargo has not changed the city's geography. The lagoon is still water and mud. But the city has done something rarer than mining gold. It has convinced strangers to trust its promises. In the end, Venice's greatest export was not pepper or silk. It was a model of how law, logistics, coin standards, and public banking can fuse into a financial empire. Later cities copied parts of it. Later states formalized it. But Venice proved the principle early. If you can make strangers trust your payments, you can make the world do business in your orbit. And that is the quiet definition of power.